There's no denying that multifamily real estate is under a lot of pressure right now, with incoming supply at some of the highest levels we've ever seen, increases in operating expenses that have resulted in material hits to property NOIs, and a lot of investors struggling with floating rate loans that at today's interest rates they just can't service. But the fact that these things are all happening right now is exactly why this could turn out to be one of the best buying opportunities we've seen in this sector for both investors and industry professionals looking to land a job in multifamily real estate. And in this video, I want to break down the key reasons why the rest of this year could come with some huge opportunities in this part of the industry and the main things that are driving these changes in the market. So the first positive indicator of things moving in the right direction in the multifamily sector today is that new construction starts are starting to drop substantially. According to data from the US Census Bureau from May, new privately owned housing unit starts on 5+ unit properties dropped from 575,000 units in May of 2023 to just 278,000 units in May of 2024, marking a 52% year-over-year decrease in new development projects that would likely be delivered in the next 2 to 3 years. And this is a consistent trend that we've seen over the last year, with new construction starts dropping as low as 251,000 units in March of this year, with the cost of debt financing pushing a lot of developers to either pause or cancel their projects altogether, and the influx of new supply that we're seeing delivered in the market today is making it really tough to underwrite any significant rent growth that could make up the difference when analyzing these deals. According to the chief economist at RealPage, 12 of the largest 50 US metros saw 0 new construction starts in the second quarter of this year, and even markets like Austin, Denver, Raleigh-Durham, and Salt Lake City, which have seen massive supply growth over the last few years, each saw fewer than 500 new unit starts in Q2 of 2024. And while right now we're seeing a huge oversupply of new deliveries driving down rental rates in a lot of markets across the country, with deliveries expected to peak in the third quarter of this year, according to Newmark research, and many of the markets that are seeing the highest number of deliveries of completed apartment units today also being the markets that have seen the biggest population growth over the last 12 to 24 months, it's very likely that most of this new supply will be absorbed relatively quickly, and when deliveries start to fall and this new product is leased up, rent growth is likely to pick back up in a very big way. And when you combine this with home prices that have risen by almost 42% over the last 4 years, and 30-year mortgage rates for many borrowers across the country at over 7% interest rates, a lot of would-be homeowners are becoming renters by necessity right now. And even for those that could buy today, this is becoming less and less of a path that people are choosing to take, with the spread between the monthly cost of homeownership and the monthly cost of renting an apartment growing to $824 in the first quarter of this year, according to Newmark research. This difference is up 18.4% year over year, and in order to pay for monthly housing costs, this requires an income of over $105,000 to keep monthly housing costs below 30% of a homeowner's pre-tax pay. And at the same time that we're starting to see these positive future supply and demand dynamics, a lot of current multifamily owners are at a point where they just can't hang on until these market tailwinds kick in, and with a significant number of multifamily loans maturing over the next 2 years, this is finally resulting in distress beginning to materialize. As of Q1 of this year, $669 billion of multifamily loans were scheduled to mature between 2024 and 2026, and with 38% of 2024 maturities being financed between 2020 and 2021, when the 1-month SOFR was near zero and the 5-year US Treasury rate dropped to just 19 basis points in the summer of 2020. Many of these investors bought these properties at price points that only made sense at these record low interest interest rates and when these properties need to be refinanced or sold at the end of the loan term, with cap rates that are anywhere from 200 to 300 basis points higher than they were 3 years ago, and interest rates that are 400 to 500 basis points higher than they were at that time. A lot of borrowers are going to find themselves in a position where new loan proceeds just can't pay off their existing loan balance, which will likely lead to a lot of forced sales just to make the lender whole. And even for properties that don't have a loan maturity coming up, many of these owners are starting to see distress come directly from operations. And according to recent data from the debt tracking firm CreditIQ, 7.4% of multifamily CMBS loans were delinquent or in special servicing at the end of June of 2024, which is more than double the 3% figure we saw just 6 months prior to this at the start of this year. And between property owners not being able to service their debt and $155 billion of multifamily loans that were originated between 2020 and 2021 being scheduled to mature over the next 2 years, this could create a huge influx of newly marketed properties for sale and huge opportunities for discounts that, even over the last 2 years, have been relatively few and far between. Now, in addition to positive future supply and demand dynamics and distress related to financing, there's also a relatively high likelihood that we could start to see interest rate cuts as early as the third quarter of this year, which could have a few positive effects for multifamily buyers today. And the first is that if interest rates drop, in most cases, this is going to mean that investors can pay more for those same properties, which leads to reductions in cap rates, all else being equal. A lot of the value drops that we've seen in the multifamily sector over the last 2 years have been almost entirely due to the rise in cap rates as a result of interest rate spikes, leading to reductions in property values of 20 to 30% or more in a lot of cases. And this has even been true at properties where operating income has stayed constant or even increased slightly during this time. And by making an acquisition today ahead of potential rate cuts, investors are very likely going to see a positive swing in values in relation to those cap rate changes without having to do anything to the property's operations. And because the Fed is primarily waiting for inflation to come down before making these cuts, a drop in interest rates also very likely means that the huge increases in operating expenses that multifamily owners have seen over the last few years, primarily related to things like insurance costs, labor costs, and material costs, will finally start to slow down, making it a lot easier for property owners to increase net operating income and ultimately property value. A drop in interest rates will also often spur economic activity overall, which could lead to increased wages, job growth picking up, and ultimately more disposable income for people to spend on rent. And while this is all good news for investors, if you are trying to land a job in this part of the industry today, either at a multifamily investment firm or a brokerage team focused on this sector, this could also mean that your career prospects are finally starting to look up. If interest rates fall and at the same time transaction activity ticks up due to distressed properties hitting the market, transaction-focused job openings in acquisitions and investment sales should also start to pick up quickly, especially since many multifamily firms have kept their teams as lean as possible over the last few years. Ultimately, while a lot of multifamily owners are in a tough spot right now, there's a very good chance that we could look back on the second half of 2024 as a great time to buy, and these are all things to consider if you're a multifamily investor or looking to land a job in this part of the industry. And if you are trying to break into commercial real estate right now and you want to make sure you have the technical skills you'll need to land an analyst or associate role and pass an Excel modeling exam that might be given to you during the interview process, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the current state of the multifamily market, make sure to hit the like button and let me know. And let me know in the comments what other product types you'd like to see covered in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week. And I'll see you in the next video.